Ted, Phil, Fred. All right, how are you guys? Here's my desk. Jeff, doing good. Off to a rough start today. Okay, let's talk about rough start today. Okay. Welcome to Tradespoon and Yellow Tunnel. My name is Vlad Karpel. I'm CEO and founder of both companies. And today we're going to talk about live trading, the current market conditions, talk about credit default swaps, very important topic. Not sure how many people understand this concept. And what to expect in the market. This is, for those of you who are new, welcome. If this is your first live event, do me a favor, type in first. Also want to welcome new subscribers. This is my brief bio. Disclosures are very important. If you're new to trading stock and options, I encourage you to pause the screen and visit optionscreen.com to understand the risk associated with trading stock and options, and also read the rest of the disclaimers and disclosures. Very important. I'm not a financial advisor, not registered with FINRA or SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education and information purposes only. Please consult your financial advisor prior to making any trading decisions. All right. Let's talk about trading psychology just a little bit, right? The importance. So the idea of dichotomy of control, right? Dichotomy of control is that you can only control your own thoughts and actions, right? And in an environment where there's a lot of uncertainty about inflation, about recession, liquidity issues in the market, you really don't know what would be the next set of news, right? And they could be good, they could be bad. Market can rally 2%, market can sell off 2% in a very short period of time. So how do you deal with that uncertainty? Again, I think right now it's all about risk management, right? And today is a perfect example of Credit Suisse. The credit default swaps, widen significantly, meaning that probability of default of Credit Suisse has increased substantially. And basically based on the interview, right? There was an interview. One of the Saudi prince said that, they're probably not going to provide more liquidity or more cash if Credit Suisse needs, and based on that interview, market just collapsed across the globe, right? So you can see, first, game theory, right? You have to understand the mindset of people who are trading, right? How much risk tolerance people have right now, and how much, uncertain, how quickly they are reacting to interview, right? If this was happened 2 weeks ago, nothing would have happened, right? But today and 2 weeks ago are two different things, right? So very important to, while I'm mentioning this, is the risk, right? So the risk of defaulting for the company, right? They buy insurance, just like we're buying puts for our portfolio, they're buying insurance for, for their solvency, right? So that's what credit defaults are. So the idea, everybody worries right now about risk management, right? Whether it's Credit Suisse, regional banks, sovereign funds, right? Italy, France, Greece. Individual investors should also be concerned about their solvency, right? Making sure that you have enough ample of cash, right? And no matter what happens in the market, you know what your portfolio drawdown is, right? All the banks are going through this right now. Governments will come out and impose stricter rules in terms of how much cash and what banks can and cannot have on their balance sheet. Individuals are the same thing. Retail investors, the same thing. You need to look at your portfolio. You need to buy insurance, right? You buy insurance, puts, gold, I don't know, treasuries, right? You buy insurance, and then you look at how many positions you have, and if the market drops 20%, what your portfolio will look like, right? So these negative and positive visualization exercises are more important than ever before, right? Because there are already signals of credit issues throughout the world. It's not just regional, one bank in California, right? This is going to be across the globe. So number of positions, in my journal, I actually write down every position that I have and how much maximum risk is, right? Maximum, not even 50% stop loss, because you can see with regional banks, the stop loss sometimes don't work, right? When the stock opens in 5% down, well, you might not get filled on your stop loss, right? So I encourage you to just be a little bit more conservative and look at the wider stop losses, with the assumption that overnight, Credit Suisse can drop 30%. So if you're an investor in Credit Suisse, and you had a 10% stop loss, it might have not worked, right? So then you build your position size based on the assumption that, okay, 20% drop or something along those lines. So it's all about number of positions and position size. Right? Idea is to avoid fight or flight response, right? If you invested in Credit Suisse and you wake up and your position is down 30-40%, right? You get these fight or flight response. You want to avoid it. How do you avoid it? I mean, it's almost impossible, right? The only way you can avoid the fight or flight response is, especially if you're investing in high risk assets, right? If you invest into ARK Innovation, any high beta stocks, Bitcoin, they can move significantly. So to avoid this is, again, number of positions and position size. Game theory is extremely important, right? Understanding that, Credit Suisse default swaps, this was an issue in January, February, and March, right? But January and February, all these issues were ignored, right? Because everybody was in soft landing, right? Overnight, Goldman Sachs, Apollo, they all basically came out with newsletters, right, to their clients. Basically says we were in no landing camp, last week, and now we're in hard landing camp because of the, issues in small banks, right? So you have to understand who you're trading against and what their mindset, how nervous they are, and now everybody's nervous, everybody's shifting. Not everybody, but a lot of people are shifting from no landing to hard landing. And any little news, right, even an interview can cause these global sell-offs, which is not a very good environment to trade in, right, in terms of how much uncertainty it is in the market. So very important, right? It's not my opinion what matters, it's opinion of majority, right? You have to predict what majority of the people think and how they will react. Meanwhile, I did put down, if you never dealt with, I remember I used to work in a hedge fund and they were talking about these credit default swaps trading, like what this is, sounds like, gibberish, but it's important, right? Why is it? We don't trade credit default swaps because you have to have, billions, millions of dollars, right? and you have to be an institutional client. But credit default swaps, I mean, without spending too much time, think of it as just puts, right? It's a put, you know, when you have stock portfolio, you buy a put, right? When you're a bank and you have a portfolio, you know, to ensure loss of principal, right? To ensure the loss of principal on your balance sheet, you buy these credit default swaps, right? You have a counterparty, buyer and a seller, right? Buyer, and it's not very liquid, you know, there are some liquidity issues. We don't need to know about this, but this idea of credit spread. Think of credit spreads as a put premium, right? When everything is nice and the sun is shining, right? The puts, when volatility is low, when VIX is low, right? When VIX is low, puts are cheap, right? Puts are cheap and calls are cheap when VIX is low, right? When VIX jumps back to 30, puts are very expensive. It's the same thing with credit default swaps, right? Credit default swaps, it's a swap between two parties, right? Buyer and a seller. And the buyer is usually like a bank, right? Like Credit Suisse. And, you know, this, the delta, the difference between credit default swap and the benchmark, right? It could be a 10-year note, it could be a LIBOR, whatever. It's different swaps have different benchmarks, but the idea that under normal circumstances everything is nice and wonderful, right? In 10-year yields, not a lot of spread in a 10-year yield, but in 1-year swap between the benchmark, I don't know, let's call it 2-year note. I mean, Credit Suisse probably have what is it, German or Swiss, you know, equivalent. Like bonds, I don't know what Swiss have, but irrelevant, something that's very secured and protected by government, right? When this spread widens, right? When this spread widens to, you know, I think right now it's 600 basis or 800 basis, that's an indication that, you know, when Credit Suisse have to insure their money again next time, right? They have to pay a lot more premium, right? Which will affect their earnings. And which, you know, in this case represents high probability that they may or may not, you know, default, right? Default on their credit. Very important concept. We're going to hear this a lot, right? Not just this year, but in many years to come, right? It's going to be an issue, right? Everybody talked about this in 2008. Everybody talked about this in your, you know, European sovereign debt crisis. So it's an important concept to understand, right? To understand. I mean, you know, I don't know. I mean, you can watch these swaps or you can listen to the news, but every time somebody says, you know, credit default swaps has widened, that means that volatility. Think of it as VIX jumps to extreme, right? And you know, when VIX jumps to extreme, you know, people are sitting on the edge. All right. Any questions on the credit default swaps? Bob, present and ready. Jeff, how rough can it get? Good morning, Ted. How rough can it get? My opinion hasn't changed, right? I don't think, you know, I kind of talked about this for the past 14 months, right? Bob said, well, Vlad, what's the trigger, right? Last week I said, I don't know what the trigger is, but when it comes, you know, I'll tell you. I don't know, maybe Bob jinxed it last week, but okay, here's a trigger, right? The trigger is when, you know, the counterparties, when sovereign wealth funds or when banks don't trust each other, right? Because in the Credit Suisse, right, you have to have a buyer and a seller, right? It's not a government. Where is this? There's this chart. Interesting. Yeah. So you have a seller and you have a buyer, right? And if they don't want to transact and government enforces you to buy insurance, well, that's a problem, right? That's a problem. So that's the trigger. How bad can it get? I think we talked about this many times. I still, you know, it does look like 2008, right? It feels like 2008, same types of scenarios, right? In 2008, it was hedge funds that had large mortgage-backed securities exposure. They started defaulting, right, going under, right? I think as early as January of 2008, right? Then you had the banks, you know, Bear Stearns collapse, right? Then JP Morgan bought it, market rallied, right? We're talking about April of 2008. And then in summer, right, people decided, sell in May and go away, right? And then there was a big trigger, right? Not an interview with the Prince of Saudi Arabia. It wasn't the Prince of Saudi Arabia, it was somebody, I don't remember. But there was an interview, right, at night. There was an interview, I forgot who it was, irrelevant. But in an interview, and then, this was a Lehman moment interview with it's not a trigger. This just shows you how nervous the market participant is. But I agree with Bob, you need a trigger. You need a trigger for this big sell-off. How bad will it get? I'm in the camp where I do believe that, right now, banks are a lot better funded and there's a lot less liquidity issues than in 2008, right? We didn't have Dodd-Frank, and all these different regulations. So top to bottom, it dropped 56% spiders, right, in 2008. I don't think we're going to get there, right? Just because the assumption that, with all those stress tests, plus, 2008 is only 14 years ago, all these regulators, they know what to do. Before, everybody was arguing what to do, so it took like a year for them to figure out what to do, right? And now you can see based on U.S. government response, it was overnight, right? 2 nights. And so I don't think it's going to be that bad. Average bear market with recession is around 40%, 45%. So I'm going to assume that we are in the bear market. I'm going to make an assumption that we will have, some kind of landing, hard landing, right? Not a soft landing, hard landing. We will be in some kind of mild recession. And 44% drop from top to bottom, right? That's an average drop. And I think this is an average. We have to wait and see, if all of a sudden Greece will start defaulting on its debt, okay, then it's a different story. But assuming there's few companies defaulting on its debt and earnings season, right? Right now, the next is earnings season. I was reading the Twitter and they are upgrading Netflix to 400 because Netflix is just going to take over the world. As long as the analysts are still haven't adjusted their target, there's a lot more room to run to the downside, right? So the reality has to kick in. And right now there's a big disconnect between what the analyst community thinks the company will earn and what they will actually earn, right? They're kind of ignoring these signs. So that means there is more room to the downside. So 40% will take us top to bottom around 300 to 80. So somewhere, I've seen people call 320. That's very mild recession. I don't, that would be below average, right? So the below average recession, that would take us to 320. Average recession will take us to 280, and Lehman type of financial crisis, we will revisit the lows of the pandemic. Where exactly it's going to happen? Well, that depends on these triggers, right? If it's going to be localized and it's going to be maybe Credit Suisse and maybe, Silver, or not Silver, but Silicon Valley Bank, okay, then, and negative earnings recessions, okay, then 40%. If it's going to get worse, significantly worse, then, okay, then it could be like, but those are some of the frame of references. Meanwhile, retail sales come in as expected, right? Down. They were, the previous were revised from 3 to 3.2. So February people spend less, right? That's negative news. It's within expectation, so it's not really negative, but core CPI came in significantly better than expected, right? So you have bad news and good news, right? You can interpret core CPI in different ways. Some people interpret, okay, the inflation is under control. This is great. That's soft landing interpretation. Hard landing interpretation, the reason, inflation is down and PPI is down and CPI is going to be down is because, lack of demand, right? Demand is start going down. And that's why you have these prices. So you can interpret in different ways. Right now, market is down 1.5%. So in terms of support and resistance, again, well, nothing has changed, right? We talked about for the bulls, you know, I think Bob asked yesterday, when do I buy Tesla? I say you buy Tesla when it breaks at least above 392 if you want to buy it. So that opinion hasn't changed, right? Wait till break. This is an important line in a sense, short term for day traders. I would say, you know, if you want to buy, not day traders, but aggressive short-term traders. If you're an aggressive short-term trader, you're trying to squeeze a couple % here and there, okay, then this is your buy signal, right? At least, you know, some kind of confirmation that we're above this. Until then, we're trading in the range, right? We're trading in the range, right? We're going to have good interviews, and the market is going to drop, and we're going to have a bad interviews. I mean, good news interviews, market is going to go up. Bad interviews going to go down. So that's your range, right? Right now we are in the middle of this range, right? By end of the day, we could be at 382. By end of the day, we could be at 392. It just depends on what kind of news is going to come. At some point, it will exit out of this range. I'm going to make a bold assumption that that will happen during the next Fed meeting next week, right? All eyes on Fed, right? What are they going to do? What do they think? Are they relaxed? Are they tense? Right? And you can see, as long as the 2-year yield moves 10% up and down every day, that's a problem, right? That is a problem. 10-year yield should not move 10%. This is not a regional bank. Okay, so those are the main observations. Dollar also rallies, right? Strong rally in the dollar, also not good for the market. VIX is back at 27. QQQ is holding on, right? There's still, you know, the idea that this is localized, it's only, you know, value stocks, right? Technology is going to be okay. My opinion hasn't changed, sell into the rallies, right? Okay. Any questions? So Jeff, thank you. Todd, good morning. All right, Jeff. Selling credit call spread is doing well. Thank you, Jeff. No bailouts for us. Thank you, Bob. Desi is here. Desi, you know, gets a credit, right? He called JP Morgan, or we were talking about last week. You know, Desi is back, right? We talked about this range, right? Up and down, up and down. I basically said, you know, last week that before this swap, I said, you know, we could have a rally, right? We could have a rally, right? But don't buy or don't sell your put until we break through this level. Since we didn't break this level, well, I mean, obviously there's a black swan type of event, and you know, JP Morgan is down and TLT is up, right? And that relationship is going to continue. Good time to sell. Credit spreads. I would, you know, just like I explained, market is trading in a range, right? It's a flip of a coin. I mean, you flip of a coin, you know, and you know, if you ask me where's the market going to be, you know, in the next hour or you know, even Friday, right? All these events, they don't really matter, right? PPI doesn't matter, CPI doesn't matter. You know, inflation is the old news, right? We were talking about inflation for the past 14 months. Right now, there is, I think, 70% or 60% chance Fed will, you know, lower interest rates by 100 basis points by end of the year, right? We were, you know, 0% chance they even gonna have any rate hikes. Now there is talk about 100 basis points rate cuts, right? So, you know, what used to be bad news is now good news, and what used to be good news last week are now bad news, right? You know, retail sales, if they're bad, used to be a good news because that means the Fed doesn't have to raise cuts, but now they're bad news because if consumers don't spend, then that's not good. So, I mean, we're below 50%, right? So, I mean, if you're aggressive short-term trader, this is 50-50 chance, right? I mean, you can say, okay, Vlad, I can look at 1 hour. As long as we're trading below, I can sell call spreads, right? But if it goes up, right, then I'll close it. I mean, this is day trading, right? And I would not trade. Better opportunities are here, right? Better opportunities are here. You buy, right? Because you assume that December low will hold, right? If you're aggressive short-term trader, you buy. because you assume this level hold, or you sell here because you assume that what's the catalyst, right? What's the catalyst to break through this window? So you sell, and then you have well-defined stops, right? Your risk is limited, right? If we are 395, okay, this is the time it's going to break, so you're out. But you assume that 70% of the time market does this, right? 70% of the time market does this. So if you're looking for these trades with 70% probability, you sell at these support and resistance level, and you don't have to have a lot of training in technical analysis, right? I mean, this is just you train your eye and you kind of see where okay, it's this week low, it's last week this week lows, now highs. So that's your support resistance level. So that's day trading, right? Now, holistically, looking at the entire portfolio, I propose to have, bearish portfolio, right? So look at spiders. Spiders are down 1%. If your portfolio is up 1%, I think you're okay. If you're bullish, you still, if you believe in soft landing, spiders are down 1%, you down 1%, I think it's also okay, right? But anything beyond that, I would not do. So to answer your question, would I sell credit call spread? I do have credit call spread in September. My answer would be, it depends on your portfolio composition, right? So if you're bullish, if your overall portfolio bullish to neutral, I would sell call spread just as a hedge, right? I mean, banks are buying hedges. That price of the hedges are going up. This is the time to buy hedges. Buy put spread, sell call spread, because you need to insure your portfolio, right? You could be the biggest bull in the world, but I encourage you to consider buying put spread just in case, right? If you're bear, okay, you can add to your bearish position, but you're a little bit too late, right? You're a little bit too late. You want to wait till rallies, right? You're gonna have these 2% rallies, right? Just like yesterday, we had a strong rebound. You're gonna have these rebounds, right? They're meaningful, right? 3-4% rebound in 1 or 2 days. So you're gonna have these moves quite often. You got to be patient, right? In this market, you got to be patient. So hopefully that answer your question, Jeff. Last Friday, I purchased it's collapsed. Sorry, Desi. You get whipsaw, right? I mean, I did think we're going to potentially have a rally, like short-term rally, but I guess in retrospect, I would just kind of repeat what I said, right? I was bullish. I was bullish. Last time we met, back in June, call. But if you do have a put, I mean, you do have a stop loss, right? I mean, I think we had this conversation when we were here, if I'm not mistaken. So I said there is the opportunity, there is a chance that if the market rallies, JP Morgan is going to rally. That's true. But then you wait, right? If you do see a breakout, then you're out, right? So next time, maybe consider instead of doing Fridays like weekly options, you can go 2 weeks out, 3 weeks out to give yourself more room and more time, right? Because clearly, you trade when you have a breakout, right? You go long on JP Morgan once it rallies. But if it's unable to break, tried 3 times and it failed, or 4 times and it failed many times, then so I would go back to journal and I would write that down, right? And next time you're confronted with the same choice, right? The next time JP Morgan is at 144 and you buy and put, then you can go back to your notes and kind of decide, okay, what should I do, right? So notes are very important. You can see, QQQ is almost, not positive, but rebounding back. All right, any other questions? Jeff, what is the extreme level of VIX? So extreme level of VIX, VIX has been trading without any, black swan events. It has been trading between 40 and what is it, 18 since 2020, right? Well, not 2020, the pandemic high, right? We have pandemic. So extreme, if you want to talk about extreme moments like Lehman collapse or pandemic, COVID, then extreme levels are 70, 80, right? Very rarely do we get to 70, 80, right? You know, and then we had for the past, what is it? 2.5, I don't know, for the past 2.5 years, any type of sell-offs, the extreme was about, you know, 35, 40. So it's not an extreme, it's norm. So anything above this, same thing, once you start seeing this, you know that we have a trigger. So if and when this event occur, you would watch 40 level, right? Because, you know, we are at 30 this week, we could be at 40 next week, right? But that doesn't mean it's extreme, right? But if we drop, and then we do this, then I would look for trigger, right? Most likely there's something, again, some kind of, you know, maybe Credit Suisse finally defaults, right? It's not just an interview, but actual collapse. We're still above yesterday's low, right? I agree. Yeah, we're still above yesterday's low. We're above, you know, I would say that for bulls and bears, I would watch December lows, right? This was the worst December, you know, in past 40 years, right? We had worst December, then we followed by best January, and now we're gonna have worst March, right? So we have these historical moves, which is not good. So December lows, right? As long as we're above December lows, it's kind of, you know, there is a chance to revisit at least this downtrend, right? It is a chance to, and this is going to be determined by the Fed, right? There's two ways the market is going to go next week. It's either going to retest the lows or it's going to revisit the uptrend. And this all depends on what Jerome Powell is going to say, right? I'm an eternal optimist, right? I think Jerome Powell is going to do a good job and calm the market. All right, and then the market gets back to 400. If he's unable to do this because nobody wants his job, it's a very difficult job, right? And if he's unable to calm the market, then okay, then right away we'll break December lows and revisit 350 in a very short period of time. Fred, thank you. Thank you for your kind words. Too late to short XLF. Again, my trigger to get aggressive, you know, if I see that after Fed, after next week, if the market does this, this is my signal to start shorting more aggressively, maybe even 2 to 1, right? If QQQ drops by 1%, then my portfolio will go up by 2%. Anything about 2 to 1, I think it's a mistake, right? Because you're gonna get these whipsaws and you won't be able to hold on to your short positions. But I would get incrementally more bearish if we break through this level. Because as long as we did not break December lows, you have this high chance that next week, you know, Fed will, Jerome Powell is going to do a good job and be able to calm the markets. Yeah. And what that means is, you know, I think if he says, listen, yes, we have issues, but we're ready to do anything. We're going to lower our interest rate. Maybe we pause. You know, PPI is down significantly, right? You know, there's credit issues. You know, we're going to pause and we're going to start lowering interest rates this year. Don't worry about, guys. Everything's going to be okay. If he says something like this, then the market will have this short-term rally, right? If he's going to be tense and not say that, then, you know, then market will stall. All right, any questions? Offers the best opportunity to the downside. At Spiders QQQ IWM. I still think the elephant in the room is QQQ, right? It was very weak going into December, right? I already reached 52-week low. still very high multiple, right, in QQQs. And we still have analysts upgrading these stocks to outperform, right? So everybody's already bearish about everything but technology, right? You can see it right now, right? Value stocks are down 1.5%. QQQ is down. So traditionally, QQQ always sells off more than blue chip stocks, right? Because at some point, people are going to say, well, at least hide out in blue chip stocks and get your dividend, right? So I think the elephant in the room is, your Microsofts of the world, your, Tesla of the world. They're going to get hit the most. So if I had to choose to short, I'm personally shorting QQQs. Short term, that might not be a good idea. So again, timeline. If we're talking about, June, September, I would say technology. If you're talking about a few next weeks, it's definitely QQQ is actually outperforming, and the biggest drop is in Russell 2000, right? Russell 2000. And let me stand corrected. No, I think Russell 2000 is going to drop more than QQQ. But again, it's a nature. But it's going to be in line, right? It's not like it's going to be divergence, right? Because there's always a multiple. So the magnitude of the move is probably going to be, well, let's just verify that. Let's go back to 2008. So I don't have to guess how much did the Russell 2000 drop. Yeah, so Russell 2000 dropped 59%. QQQ dropped, I think, 55%, right? QQQ. So Russell 59 and technology 55. I mean, so yes, so small. I mean, I'm actually surprised. I thought small cap would drop more than that, but a little bit more this time. I mean, okay, same thing. But the problem is that Russell, well, let's see, QQQ is from the bottom. Let's see, QQQ from the bottom is 15%, right? And IWM from the bottom is only 4%, right? So small caps are leading to the downside, but at the end, they will almost be the same. So that means at this point of time, I go back to my QQQ answer. I think out of 3, QQQ drops the most. QQQ drops the most. Because small cap stocks already dropped a lot, right? Already dropped more than technology, and everybody's still hiding in technology, right? People are dropping small cap stocks, but they think Tesla and Apple is going to do well. That's a short-term rebound between now and Friday. Between now and Friday, it's a flip of a coin. Yes, it could be a rebound. Yes, it could sell off. The main event on Friday is the leading economic indicators. It's the same thing, right? If it's negative, if it's worse than negative 0.4, then the sell-off continues. If it's better, then you have a short-term rebound. It has been deteriorating in the past 12 months. I'm going to make a bold assumption that it's going to continue to deteriorate and market is going to sell off. But, I'm flipping a coin. Maybe 55% it drops, 45% it rallies. I don't think this is an event. And obviously there could be another interview of another bank. And or vice versa, right? Tomorrow Saudi says, listen, you guys misinterpreted what I said. Yes, if Credit Suisse defaults or have liquidity issues, we're gonna buy another 10% of Credit Suisse, and then market rallies, right? So you are at the mercy of these news, right? Interviews, right? Really small news, and these algorithms, right? These black box algorithms. They're just going to move the market up and down 2%. At this point, it's almost a norm for market to move, spiders to move 1.5%. Right? So when spiders move 2% up or down, that's norm, right? It's just how it's going to be for the next few months. Jeff, okay, thank you. Is the combination of unprecedented speed of financial transaction opinion Twitter creating the perfect storm? Twitter creating the perfect storm. I mean, I don't know what that exactly means. You know, my English is my second language. So the combination of the unprecedented speed of financial transactions and opinion, Twitter creating the perfect storm. Okay, what's the definition of the perfect storm? I'm going back to the Peterson book. That's directed by Walden Peterson, based on based on a non-fiction book with the name Sebastian John. So I'm going to make an assumption perfect storm looks like this, right? That the disaster is coming. My opinion, it's the same thing. The perfect storm is going to come when we have a second trigger, right? We had Bear Stearns in April, and it took Lehman to collapse in September, right? So we're talking about 6 months. So it could be the same thing in the next 12 months, right? In the next 12 months, we're going to wait for the Lehman collapse. At this point, there is a high probability that something like this will happen. But it doesn't have to happen, right? It doesn't have to happen, right? Maybe, you know, there's, you know, soft landing guys did not, you know, they might say they switch the camp, but they are not selling their position. There is no panic in the market, right? So once you see a panic in the market above the average volume, that's, you know, that's a black swan event. Right now, you know, you basically have to wait for the next black swan event. I don't think it's going to be just because of, you know, people's conversation. Goldman came out, no more rate hikes. Yeah, Goldman came out, no more rate hikes. I think Apollo Goods, you know, I think futures indicate possibility of a not only no more rate hikes, but 100 basis points rate drop, right? That the Fed will drop rates by 100 basis points by the end of this year, right? Because why? Not because inflation is dropping, but because they think that we are in a recession. Fred, thank you. Fred, thank you. Fred, perfect storm confluence of two worst case scenarios. All right, thank you. Of two worst case scenarios, right? I mean, we do have two worst case scenarios. So, okay. Any other questions? Meanwhile, let's see. Spider, I mean, were we at session low or close to that? Meanwhile, we are, yeah, we closed the gap, right? We dropped, closed the gap, and we're close to session low. You know, we went from, what is it, 393 to 381. 12 divided by 2.6. So we're trading below 50%, right? So bears are in control. What is our magic ball friend says? Crystal ball, magic ball. 395, 388. We're trading below that. So, and notice Vector got a lot more negative, right? Basically saying if Powell doesn't save the world, right? If Powell doesn't save the world, we're going to hit 52-week low, right? By end of March. So if there are no, and so I would agree with the model, right? The momentum is to the downside. The only thing that I can think can save the day, short term, like temporary save the day, is Jerome Powell. So if Jerome Powell says something positive, the model is going to be incorrect. If he's not gonna say anything positive or not say anything at all, right? If they cancel this meeting, then we'll probably hit 52-week low. Yeah, in the next 10 to 20 days. All right. Any other questions? Okay, let's review position. This is all nice and wonderful, but what do we do? Oh, and I forgot about the earnings. That's not good. Okay, so I did do earnings, Leonard. Okay, it's flat. So again, I said the risk is to the downside in Leonard. So let's close that position, especially if they had, better than expected earnings. Okay, so 15 cents. 109. So I did sell 109 call. I'm going to try to close it for 10 cents. Right, close 10 cents. All right, so I did sell Leonard for 30 cents. Didn't sell the put spread, right? If you were at the closing bell, the risk is to the downside. If they had negative earnings with today's market, it would be easily down more than 10%. So I only sold call spread. I think it's a safer bet, right? Right now, if I have a choice between selling put spread and selling call spread, I would take selling call spread because, the risk is always to the downside. Not to say that we're not going to have rallies, but, and silver got filled. I don't know why there's a delay. I have to look at this. Oh no, okay. So silver, right? Buy into the sell. I would be a buyer into the rallies, right? So people continue to look for hedges, right? One place is, precious metals, right? So the trade has changed, right? Instead of a inflation trade that we had since October, we're now into a recession trade, right? So forget about the correlations in the past 14 months. We're going to have new correlations, right? And one of them is, spiders is down, TLT is up, right? This is new. Hasn't happened in the past 14 months, right? So TLT is up when, QQQ is down. That's the new trend. And the new trend is that, with this new black swan event, silver is up, right? So silver is not going to be trading like a precious metal. It's going to be trading like a hedge, right? Market is down, silver is up. Market is up, silver is down. So I did trim the position. I still have more, right? I would be a buyer into the pullbacks. What's next? NOC. Again, not highly correlated to the market, even though today it is, but I still think there is more room to the upside. The risk for this position is some kind of a peace agreement, which could happen. Actually, I would downsize your position. China came out with this new proposal, right, in writing. They said every government has to respect boundaries, right, sovereign boundaries of every country. There shouldn't be any, what do you call it? It should be not tariffs, but what is the U.S. government placing on government? Not tariffs, but sanctions. There shouldn't be any sanctions, right? They're very funny. That makes sense. You kind of can see what they're trying to do, right? And they, also said that China has to have a bigger influence on the world order, right? On the world order. Hence, they brokered a peace agreement between Saudis and Iran, right? Very unusual situation, right? They were able to bring these two countries like enemies that for the past, I don't know how many years, that they actually signed a peace agreement, right? And they're probably gonna resolve the Yemen situation also. And who was broker in this? It wasn't Biden, right? It wasn't U.S. administration. It was, China administration. And now he's flying to Moscow, right? Now Xi Jinping Xi. I always mispronounce, but the president, the prime minister of China is now, president of China is now flying to Russia, right? And he's going to have this teleconference, I think this week, with Ukrainian president. Again, it's a black swan event if they're going to reach peace agreement, right? If you read my blog, right? If you read the blog and Yellow Tunnel, power trading markets. I think it's this guy. This, right? This day of the Oprichnik, right? Day of the Oprichnik, basically from historical point of view and just knowing President Putin, I cannot imagine that he would agree to this peace agreement, right? Basically, he has to withdraw all his forces from the Ukraine. But that's irrational thinking, right? And he's irrational. From rational thinking, this is the last chance, right? Because if China actually imposed sanctions against Russia, like India actually joined the sanctions on oil, right? So the last man standing is China, and China is going to Russia not to drink tea and go to banya, right? They're going there, or sauna. They're going there to talk about Ukraine. And I assume after that declaration and after the peace agreement, they're going to try to force Russia to, withdraw the forces. If that happens, I think it's a black swan event. I don't think it's going to happen. But if it does, then NOC is going to fall off, right? It's just going to have a big drop. So if you do have NOC, maybe it makes sense to trim the position, which I did. But, I think the probability of that is very low. Okay, it's there, but it's low. Okay, QQQ. Still have 295, 300 call. Again, I think that's the only, between this and, biotech is going to expire worthless. So I only have one April bullish position, right? And spiders. So I have two spiders position. Overall, my portfolio is negative, right? Bearish. So I'm bearish June call spread. We talked about call spreads in June. Still bearish June call spreads. Still have a June put. Probably going to add to this put if we break through December lows. And still have 290 to 70 put spread. So September, June, bearish. If you're uncomfortable trading options, I propose to trade as H, inverse ETF. I have as H position. Still have silver position, still have spiders position, so still have small. It's important to be long and short, right? You can have different ratio, 2 to 1, 3 to 1. That's all I understand based on your view on the market. But I don't think you should be all bullish positions, all bearish, because market doesn't trade one way, and you're going to have rallies and you're going to have sell-offs. Continue to buy on pullbacks, TLT. And this guy is a problem. 80-85 and biotech is probably going to expire worthless. That's actually holding up pretty well. Okay. Well, we'll see. Meanwhile, QQQ is holding up, rotation into technology, right? Microsoft, people think that Microsoft is going to be able to weather the storm, right? Weather the storm, and Microsoft is up, and probably Apple is up as well. If I have to guess. No, Apple is slightly down. Okay. How about Google? Is Google up? Google slightly down. How about Netflix got upgraded today? Did market react? Yeah, market react. So Netflix is up on the upgrade. Okay. You can see FCX is falling off the cliff, right? Copper, that's their argument, right, that we're signs of recession. And I think oil is breaking down, right? And oil is basically revisiting 52-week low. So also sitting on the key support, and crude oil is breaking down, right? Crude oil below 60, right? All bearish, all recession, right? All these data points confirm that we're probably heading into a hard landing. We're probably heading into hard landing, and oil is 60 handle. questions? Ray Elias said, Bank's debacle is canary in the coal mine. Canary in the coal mine. Thank you, TJ. Is bumpy ride. It is going to be bumpy ride, right? It is going to be bumpy ride. I would, I don't think it matters which campaign you belong to, right? If I was a bull, I would think this way. There's really no reason to get aggressive buying, adding to your long positions until we break through this downtrend, right? Right. I mean, we did break through the downtrend in January, which I did not anticipate. But if you're a bull at this point, you have a clearly defined downtrend. As long as we are below this downtrend, there's no reason to get aggressively bullish, even if you are in a soft landing. You wait, right? And I would maybe 1 out of 4 position add the put spread, just September put spread, just in case, right? You insure your house, maybe it makes sense to insure your portfolio, right? And then everything else you wait, right? Right now, obviously, everything points to recession. Last week, everything was pointing to no landing. So, every week things gonna change. TJ, thank you. 912. All right. Russell 2000. So let's see. In Russell 2000 already sitting at lows. I would watch Russell 2000. Right, this is the last support. Right, so if Russell 2000 breaks through the December lows, it's already through in December low. That's a problem. Crude oil is already breaking, right? So bulls should be nervous, right? Crude oil is breaking through, December lows, right? Which is not good, right? That's not. So you already see some asset classes breaking through December lows, right? So, when is the Fed meeting? March 21st. March 21st. March 21st is, okay, so next Wednesday. So we'll see. We'll see what happens. But the most important is are the rates, right? So 10-year yield, I would watch 10-year yield, right? It broke to the 350 again, right? So it's below this June high, and it's sitting at this key support about 336, right? Made new lows, I would watch that level, right? So even if Spiders doesn't break the 52-week low, December lows, but 10-year yield starts breaking like oil, right? If it's gonna start acting like oil and does this, then I would add to your hedges. Bob, Bitcoin, my opinion hasn't changed in the past 2 years. Bitcoin is a proxy for risk. I am surprised, right? You have this divergence, right, where QQQ is also not falling, right? So think of it as QQQ. I'm bearish on QQ. I think this move to Microsoft and move to Bitcoin, it's temporary, right? Because people don't change their opinion very quickly, right? They don't change, right? Talking to Strangers is a second book. I love it. So if you guys haven't read the book, very relevant for trading market, right? It just shows you human nature, and sometimes you have this information that completely proves certain point, right? But people still don't listen. And not because they're stubborn, right? It's not the question of being stubborn. Even though before I read this book, I always thought that people are stubborn, right? I used to have an analogy of Old Testament, right? Jews leaving Egypt, right? When Moses went to Pharaoh and said, "Listen, let my people go," and there is a 7 plagues, right? And only when the extreme happened, right? Only if the last, only when the child of Pharaoh died and all the children in Egypt died, then Pharaoh changed his mind, right? So I always thought it's human stubbornness, right? So now I don't say, well, I still think that way, but there's another viewpoint, right? Malcolm Gladwell. It's not because as a human we default to truth and transparency, because Otherwise, our society doesn't work, right? If we all don't trust each other, right, like banks, if banks don't trust each other, then financial system is collapsing, right? If humans don't trust each other, then there will be chaos. So it's a good perspective. Like, I like that, right? And in the financial world, it makes sense. So people say they're in hard landing, but they're still buying Microsoft, right? A lot of people are buying Microsoft today, even though they said hard landing. Well, that doesn't make a lot of sense, right? So you have that divergence. It's just people defaulting to truth, transparency, and that, you know, we can avoid the financial crisis. Okay, great. But I'm bearish on Bitcoin. How to buy put call options? I would encourage you to. So the question: how do you buy put and calls? I mean, first of all, you can, you know, subscribe to Elite, and you actually can see how I buy puts and calls, right? And what puts and calls to buy, right? So you can actually 280, 290. But if you want to learn how to buy puts and calls, I would go into event recordings, right? It's free. You don't have to pay anything. I believe in education, right? I come from a family of educators. So you go to the recordings, you go to Active Investor Workshop, you type in call, right? And, you know, there's a lot of workshops on, you know, call spreads, you know, leaps, you know, trading options. I would just watch these webinars for free. Also in our learning center, I will go to Smart Trading Guide. No, yeah, I will go to video training, and, you know, if click on option basics, right? Click on option basics, you know, and you have videos on, you know, how to trade puts and how to trade calls. So I'm still hopeful, and this is free, right? The best part, it's free. Free is not always good, right? So we do have one-on-one training. We do have one-on-one coaching training, and I'll put that in. I encourage you, I mean, obviously it costs money, you know, but if you cannot, you know, if you do have some discretionary funds, consider, you know, especially in this environment, you know, I'm going to make a bold statement: whatever you're going to spend on coaching program, you're going to get back within the next 12 months in possible losses, because you're kind of learning on your own, right? Learning options on your own, unfortunately, you're learning on your own mistakes. But if you have one-on-one coaching, you're still going to learn on your own mistakes, but in my experience, your mistakes are going to be much smaller, and will be, you know, well paid by this coaching program. Credit Suisse is a Euro Lehman moment? No, I don't think it's a Lehman moment, because this was just an interview, right? This is, Credit Suisse has not default. They came out and said they have inflows of cash. There is no run on bank. This is just an interview, hypothetical situation. You know, will Saudi invest money? And the answer was no, so market just collapsed. So, but no, it's not a Lehman moment. Thank you. CPKC merging. Okay, thank you, Bob. DJ, thank you. All right, 9:19, you guys have been great. Thank you very much. Scott will be here at the closing bell. Please support us on YouTube. If you haven't clicked on subscribe, right? Please click on subscribe. Every day I will give you my opinion, right? You will get a video on my opinion on the market support resistance, what breaks, what doesn't, trade of the day. And on Wednesday, you know, if you've never been at the closing bell, this is your opportunity to meet Scott and, you know, be at the closing bell. All right, thank you very much and have a great day. TJ, thank you. Bob, thank you. Bill, thank you. Brett, thank you. TJ, thanks. Yeah, I like to make fun of myself. All right, thank you. Take care.